So before I get to the actual number, I think there's a couple of things that people can do to really enhance their number. So Alistair kindly explained how advantaged these tax relief pensions are. But then we've got, if we think of, if you're single, then you've got a personal allowance, and you're allowed to receive once you're not, well, whilst you're working or not working, you can still receive some tax-free money. Pensions are treated as pay. So when you start taking them, they're still taxed under the PAYE system. So but they're just having tax taken off. They're not having national insurance taken off. But we've got a personal allowance today, £12,570. If you add the tax-free cash element to that 12,570, the 25% that we were speaking about before, that actually allows you £16,760 received tax-free. Well, that's pretty significant. And of course, if you've got a couple, that's £32,000 worth of tax-free income that you can receive in retirement. Well, so when we start looking at trying to get this capital sum that we're all after, if you are in a partnership, you're a civil partner, or you're both, or a couple, or you're both trying to plan for your retirement in the future, think about the independent taxation. Think about actually trying to have an equal amount that you're both saving into pensions, because of course, when it comes back out, you want it to be the most tax effective. What you don't want is it all lumped into one person's income, and they're getting 40%, 45% tax on their pension income. So just have a little think about that, because the tax tail when it comes back out is really quite significant. Coming back to the 4% rule, which of course is what you asked for, if we were thinking about, let's say we've got I think what the couple wanted 50,000. The most comfortable retirement planning we can have was about £50,000 a year. And if we assume that both of the couples are going to get £10,000 a year in state pensions, we can take off £20,000. So we've got a need now of £30,000. So if we take £30,000 and we multiply that by 25, and we draw down at 4%, which is our 4% rule.
Hang on, rewind. Rewind on the maths there. Why by 25?
Well, 25 is a multiple of the 4% in essence to get us to our capital lump sum amount. This 4% rule has really come about through lots of back testing of investment portfolios over the last century, really, of what an investment portfolio could continue to produce in returns if you drew down on it. Now, if you drew down 100% in the first year, we kind of know that you're only going to have 1 year's worth of income. So how much if we've got, let's say, £100,000 saved in a pension pot, how much can we take out each year? I always try and explain it to my clients of, let's just pretend this pension is the hole in the wall. And when you go to your local bank and take out £100, there's also another one next to it called pension. And you put your pension card in there and you put your PIN in, and out it comes, and you're withdrawing from that pension pot. Well, how much are you allowed, or how much can you take each month, each week from that pension pot for it not to run out over the course of your lifetime? If we look at some statistics, and I think we might touch on this later, an average couple retiring at, I don't know, 65 at the moment, one of them has a chance there's a 50% chance one of them will live to about 92, 93. So one person will still be alive into their 90s. So retirement now is a 30-year period. So what we're trying to make sure here is we've got enough money. When you go to that hole in the wall for 30 years, there's enough in there. And back testing all the data that we've got, there's no guarantees for the future, but back testing all the data, it seems to suggest that taking 4% of your money out, £100,000 will take £4,000 out a year, that your capital will still survive for a 30-year retirement.